All right, welcome back to the program. In case you're just joining us, it's still Money Line with Nancy. Like I mentioned earlier, I will be discussing African Development Bank's macroeconomic performance and outlook 2023, the report. And let me just quickly take you through that. It's a annual publication to be released in the first and third quarters of each year. And according to the African Development Bank, the publication will provide policymakers, global investors, researchers, and other development partners with an up-to-date evidence-based assessment of the continent's recent macroeconomic performance and short to medium-term outlook amid dynamic global economic developments. The new report will include forecast and analysis from the monitoring of regional and global macroeconomic developments. Professor Kevin Rama, Africa Development Bank's acting chief economist and vice president for economic governance and knowledge management, joins me now to discuss the report and what Africa can expect this year in the face of major headwinds. Good morning, Prof, and thank you for joining me on today's edition of the program.
Thank you very much for having me.
Okay, fantastic, Prof. Where should we start from? Can you quickly give me, I have just, like a highlights of your report here with me, but can you quickly give me the idea behind this? Because I know that the African Development Bank has what you call the African Economic Outlook. Why did you decide to do this? Because you at least had the complex over there in Abidjan that, puts this reports together. So why was this report done, and why is it different from the AEO?
Thank you very much, Nancy. As you know, the global economy has, of recent, become very volatile and very dynamic, with a lot of changes happening, given all the triple headwinds that the continent and the global economy has been facing. So we've had increased impacts of COVID-19. We've had also the impacts of conflicts, both local conflicts and geopolitical conflicts that we've seen, like the Russia's invasion of Ukraine. And we've also seen the growing impacts of, climate change that is increasing losses and damages for countries and actually affecting the fiscal space of countries. So we see that there's a lot of dynamism in the economy and the global headwinds that countries face. And there was need for the bank, as Africa's Development Bank, to come up with a report that provides quarterly updates in terms of where the economies of the continent is headed, so that global public investors, national policymakers, and also development partners will have a clear evidence-based understanding of where the economy is going, where to invest, where not to invest, what are the risks, and how to mitigate those risks to keep Africa going in the right direction. So that is why we came up with this report, thanks to the blessings we got from the board of the African Development Bank Group and also the president of the African Development Bank Group, Dr. Akinwumi Adesina. Thank you very much.
Okay, now, so this is the first report. This is the first macroeconomic performance and outlook report. Like you said, you'll be publishing it twice a year, so we'll be getting this report twice a year. But when you were publishing this report and getting your data, your researches across African economies, perhaps across 55 countries, if I'm not mistaken, what are the major headwinds that Africa had to deal with in 2022, and possibly are the headwinds for 2023?
Okay, thank you. As I already hinted, we have had what the president of the bank normally calls the 3 C's. We have increasing impacts of climate change that is increasing losses and damages on the continent. So the physical risks of climate change has deepened the fiscal risks that countries face. If you looked at our report, the African Economic Outlook report of 2022, you saw that we estimated that the continent will need up to $1.6 trillion between now and 2030 to address just implementing the nationally determined contributions to address climate change. And we're seeing losses and damages that is growing in the economies because of the increased impacts of climate change. But we also see a lot of conflicts that is happening, geopolitical conflicts like the Russia's invasion of Ukraine, but also regional and local conflicts that we see across the continent. It's also increasing risks for economies and creating a lot of capital outflows from this continent. But again, we have the challenges of COVID that still remain, given that Africa still has about 26% of its population vaccinated. So these were high-level risks that we saw on the continent. And these risks created a lot of domestic and external shocks that has increased the challenges on the continent. Inflation is one of them. Currency devaluation and volatility in the global financial markets is another, but also the global contraction that we're seeing, the risk of recession that we're seeing across the world is also having pass-through effects on the continent. And if I give you one typical example, the appreciation of the dollar simply meant that then the value of currencies, a lot of devaluation in Africa's currencies, and also higher cost repayment for the debt that already was high on the continent following the COVID-19 pandemic. So and that meant that countries still have a lot more to do in order to repay the existing debt. But it also constrained access to the global financial markets and capital markets for additional borrowing that is required to address the growing fiscal challenges that the continent continues to face. So a lot of all these challenges were so confounding, and it requires very bold and proactive coordinated policy options in order to be able to address them going forward. But the good news is that our report still shows that despite all these headwinds, the Africa's economies has been resilient, growing at an average percent of 3.8%, though it's down from 4.8% that we estimated in 2021. We see it as a positive rebound. And compared to the rest of the world, that's far higher than the expected growth rates across the globe. And on this continent, 53 out of its 54 countries maintain the positive growth rate, and with a stable outlook to stabilize around 4% of GDP growth rate in 2023 and 2024. Now, this is very impressive because in 2019, at the peak, when COVID-19 hit, there was a lot of prognosis that Africa's economies were going to suffer more from the impacts of COVID. And then came Russia's invasion of Ukraine that disrupted global supply chains and it pushed price inflation beyond the reach of many central banks. But African economies has been able to manage this. So when we look at all the fundamentals, fiscal deficits, inflation, current account deficits, and every other thing that we see on the continent, the trajectory is going in the right direction. Even the area of debt, we still see that there's a lot of high risk of debt because of the tightening of the global financial conditions, as I've mentioned, but still the trajectory is better than it was at the peak of 2019. So we would like to see a lot more in terms of improvements with debt management, public financial management, and other things across the continent during the years ahead. But the direction is still very positive. Thank you very much, Nancy.
Okay, Prof. Let me take you on a few things which you've mentioned, and I will start by saying that what you and your colleagues there, Dr. Akinwumi Adesina and your other vice president colleagues and all of you there, you're thinking, of course, that Africa is doing well, growth rate of 3.8%, at least in 2022. But are you also cognizant of the fact that the African continent is the youngest continent in the world, and the African continent has countries that have far way higher population growth than the growth rate of 3.8% which you're talking about. In Nigeria, for example, our third quarter growth rate was 2.25% for 2022, third quarter of 2022. Our growth rate here, population growth rate, is over 3%. You can also take other countries in Africa, Ghana, almost all the countries in Africa have high population growth rate. Prof, I see you are smiling, you know where I'm going to. So how optimistic is that figure? Because Africa should be doing more than 3.8%.
Yeah, thank you very much. That's a very clear point you raised, Nancy, because yet, even though the 3.8% is positive and reassuring that Africa's economies remain resilient, that 3.8% is nowhere near what is required for Africa to be able to break the vicious cycles of poverty. For example, the report also estimated that about 15 million Africans were driven into extreme poverty in 2022 because of the confounding effects of all that I have shared. Despite the positive growth rate, poverty is still deepening on the continent. The risk of debt default is still high on the continent and is still a major risk that we need to watch. And the reason is because of what you've raised. When growth rate is below or very near to the population growth rate, the more you're growing and the more you are growing your population, it means that you have more mouths to feed. It means that there is more need for resources to be able to sustain the population. So the growth rate should far outstrip the population growth rate if we're expecting the economies to be able to come out of poverty. And for Africa, what we estimate is that we've seen that globally, countries need to grow between 7 to 10% for a sustained period of time, up to 4 decades or 5 decades, before they can break the vicious cycles of poverty. We saw that trend in China. We saw it in South Korea. We've seen it in Singapore. It's happening in Vietnam and many other regions that we have been watching in terms of how they came out of poverty. Now, to address that, the African Development Bank Group, again under the excellent leadership of President Akinwumi Adesina and the African Union Commission, under the leadership of His Excellency Musa Faki Mahamat, have come together to commission a study that will actually try to provide a blueprint for Africa to be able to achieve that 7 to 10% percentage of growth. What we've seen on the continent over the decades, since 1960s of independence of most countries, is that countries grow fast, sometimes 8%, more than 8%, over some period of time, 8 to 10 years, 15 years, but then you see a major crash, what I call failed takeoffs on the continent. So we've been studying African economies to understand why we've had those failed takeoffs. We've seen that trend in Nigeria. We've seen it in Guinea. In Guinea. We've seen it in several countries of this continent, where you see that because of resource booms and price of natural resources that we sell in the market, when the prices of those natural resources go up, economies grow better. And once the prices crash, economies crash. So that means there's no structural transformation in the economy that can actually keep the economies at a cruising rate. So we would like to see countries get to that cruising rate. And that's why we're working with global experts, Professor Jeffrey Sachs, and many colleagues across the continent, many universities across the world, to come up with those key actions. And that study is well advanced and will be unveiled at the African Union in 2024, so that we'll be able to keep Africa at that growth rate that is required. But there are other things that we need to keep an eye on, because even though Africa needs a lot of resources in order to be able to grow that to that level, what I'll call investment-led growth for inclusive growth on the continent, we still find that capital outflows on the continent are rampant and very worrying for several reasons. You know, in 2020, there were estimates by UNCTAD that Africa loses up to $90 billion annually on illicit financial flows because of lack of transparency, leakages in the public financial management systems. And this is why also the African Development Bank Group launched the Public Financial Management Academy for Africa, which is helping countries across the continent to build capacity to do that. Because again, what we need to do is to boost domestic revenue mobilization, improve tax prudence, improve transparency, and reduce illicit flows of capital from this continent. The continent has a lot of resources. Nigeria has a lot of resources, both human capital and natural capital, and also social capital, that when brought together, we can actually lift the GDP growth significantly. So we need a lot of policy options and actions by governments at national and regional levels, but also development partners helping Africa to be able to put the growth at that level. Thank you very much, Nancy.
All right, Prof, I'll come back to policy options in a bit, but this discussion is getting interesting for me, especially with the issues that you're raising. You did mention earlier about what you and your colleagues at the African Development Bank over there in Abidjan, Cote d'Ivoire, is doing, the reports that we're expecting by 2024, and you talked about an investment-led growth. that would ensure inclusion. Prof, I'm really curious as to how there would be a balance, because if we take a look at even investment-led growth that we've seen across Africa or even the rest of the world, we also see that if you are not careful there, it creates so much inequality. I was speaking with the Oxfam country head, Oxfam International country head, 2 weeks ago on this show, and it was so startling, the figures that Oxfam released, talking about the billionaires that have been created as a result of the pandemic that happened all over the world, and even here in Africa. The effect, the rich kept on getting richer and the poor kept on getting poorer. Your report says 15 million people were pushed into extreme poverty. Prof, I hope you're understanding where I'm going to. So how do you balance that investment-led growth, that it will bring out more people, it will bring out more people out of poverty, it will be more inclusive, thereby reducing inequality, and not an investment-led growth that will create more rich people?
Yeah, thank you very much. The whole story around the rich and the poor and the distribution of the welfare gains that comes from economic growth, and the general theory of the trickle down, that when you invest more, the people, the rich grows more, and then you will be able to employ more people. And then basically that theory is something that really needs to be looked at.
Yeah.
You are very right that growing economies doesn't really translate immediately to inclusive growth. And that is why that study that I was talking about is focusing on key actions to drive inclusive growth and sustainable development in Africa. The key words there are inclusive and sustainable, because if the growth is not inclusive, you can create enclaved economies like we have in many African countries and globally, where the top echelon of the 5 to 10% of the population are very wealthy and have access to capital for production and are able to gain the benefits of trading in the market those products that are produced. And normally what happens is that technology owners reap the benefits of growth in any society. It's not just in Africa. It happens in the Americas, it happens in Europe and everywhere. So, and that's why for this report, we focus a lot on investing in that institutional capital that will allow for digitization to happen, allow to broaden the base of growth and access to production, the capital that is required for the factors of production, so that you can be able to grow economies in agriculture, where we have many of African households invested in. And that is why you may realize we just came out from the Dakar 2 summit, led by, again, the president of the African Development Bank, Dr. Kinwumi Adesina, and the chairperson of the AUC, His Excellency Macky Sall, the president of Senegal, that try to mobilize resources to help farming, both small scale, medium scale, and large scale, because it is the largest employer of labor on this continent. So we need to think of how we do growth in a way that is not just growing GDP in numbers, but actually improving the quality of life of citizens. And to do that, there are a number of things that needs to be done. If I give a typical example of COVID, which you raised, my first worry about COVID when it happened was the fiscal policies and monetary policies that could normally be implemented in such situations by easing fiscal policy and also the monetary policy. And normally the rich benefit more from that. So what is necessary is that we make sure that there's policy coordination. So when you have those monetary policy easing to increase the money flow in the economy, you also need to have fiscal policy prudence, so that you try as much as possible to provide cash transfers and opportunities for participation in the economy for small-scale enterprises, for poorer households that we know generally gets harder hit on when we have this kind of challenge. If you see the report, that the macroeconomic outlook report we just launched, you find that the poorer households suffer a lot more. Reasons because a higher proportion of their income, of their disposable income, is spent on consumables, on buying food and paying for energy. So because of that proportion, up to 47% of their income gets spent on these things. So whenever inflation increases, And food price inflation has increased like in the current years because of the factors I've mentioned. The poor get to suffer more. And that is why we need policies that actually helps to provide some cash transfers to soften the impacts of those changes on the economies. So basically balancing fiscal policy, monetary policy, but also public policy to try and ensure that we create opportunities for citizens around the world. And then for Africa, around the continent. But for Africa, we keep in mind that 60% of Africa's population are below 25 years of age. So policies must be proactively targeting the youths and women on this continent because they are the larger population, they are the more productive, hardworking population, but again, they are also more disenfranchised in the economy. So these kinds of policies that try to bring all these things together is crucial in how we move forward. And digitization is a good thing that happens because it actually levels the playing field quite a lot and creates a lot of transparency and accountability in the system. Thank you.
Okay, Prof, let's take a look a bit at debts. And I don't know how the African Development Bank, you and your colleagues over there are concerned about the ballooning debts across African countries. When I took a look at your report, at least your current account balance, you highlighted GDP growth rate for the 54 African countries, inflation rate, then fiscal balance as a percentage of GDP. Here in Nigeria, we're struggling with the last data, 44 trillion naira public debt. That's apart from the CBN ways and means. If you add it, if that is being securitized, we'll get about 77 trillion naira debts that this administration will hand over to another administration. Ghana, for example, is approaching the IMF for support. The IMF has even told Ghana's central bank, stop printing money to finance the government and all of that. So you see that it's almost the same story across African continents. How concerned is the African Development Bank with rising debt levels on the African continent? And what has been your engagement so far with head of states when you people meet with them?
Okay. Thank you very much again, Nancy. The whole issue of debt that you raised is very spot on. The mistake some people have made in the past 3 years is trying to blame COVID or even the Russia-Ukraine war as the major source of the debt accumulation on the continent. But if you look at the facts, since the HIPIC that was done in the past decade before COVID-19, we've seen a very upward trajectory in debt accumulation on the continent. And this is because of a lot of factors. One, debt in itself is not a bad thing, but the quality of debt, when it is not geared towards improving productivity in the economy and creating wealth in the economy so that you can repay the debt and still continue to be able to make benefits in terms of infrastructure, productive infrastructure, and other investments that helps to boost productivity in the economy, then there is a challenge. And what we've seen on the continent is a mixture, because in many of Africa's countries, we've seen rapid growth in productive infrastructure. In Ethiopia, in Ghana, in Nigeria, in many countries that we have seen countries struggling to try and push through the middle income, the low income trap and the middle income trap as it might apply to them by investing heavily on infrastructure. And no country will invest successfully in infrastructure without actually borrowing. So borrowing to invest in productive infrastructure is good. But the problem is that the type of debt in Africa has been changing because of, again, different classifications that has happened on the continent with regard to access to the capital markets. So when you borrow from the open market, short-term debt from commercial debt, so commercial creditors, and sometimes not very clear terms of debt negotiated, then that debt in itself becomes a challenge because it can't pay for itself. So we need to think about the changing structure of debt on the continent much more than the quantity of debt on the continent, because we've seen that since the last decade, the proportion of Paris Club debt lending to Africa has gone down significantly by 50%, now around 27% of the total debt stock. And then on the reverse, the proportion of commercial loans have gone up significantly to almost 40%. And most of the rest is now from non-Paris Club creditor group, like that sometimes don't abide by the same transparency rules that are required. So there's a lot of challenges regard to the changing structure of debt on the continent. But the quantum, in terms of the total stock of debt, is still a problem, but that's not really my major worry, because where the worry is in what is borrowed for and what the money is spent on. So that's why in the African Development Bank Group, we have taken a more systemic approach by creating in 2019, which was approved by the board, the board of the African Development Bank in 2021, what we call the Public Financial Management Academy for Africa, taking the continent countries from the issues about boosting domestic revenue mobilization, because again, you borrow more when you have less to meet your capital and recurrent expenditures. So by boosting domestic revenue mobilization through prudential tax systems, very clear and transparent systems of collection and administering the tax revenues, and so on, and also trying to create value addition to Africa's natural capital. Natural resources is what Africa really has a lot of in the world, have very significant comparative advantage and competitive advantage as well. But we spend a lot of time selling the raw materials in the global market and getting low prices for it. So we need to improve the technology input so that we can manufacture products and sell at the higher levels of the value chain. So because when we boost domestic revenue mobilization, we will reduce the need to borrow. But even with the resources we have, there's need for more prudential budgeting and public expenditure management, and we take countries through that. But we also need to deepen our financial and capital markets so that we'll be able to create wealth within the economy, and we take countries through that as well. Prudential borrowing, macro fiscal policy modeling, and more importantly, working with audit institutions, the supreme audit institutions, to ensure that we hold public servants accountable for how public resources are being utilized on the continent. It is crucial. So we go through all those whole cycle, helping debt management officers, central bank governors, central bank staff, and so on, so that they can understand what needs to be done to move this forward. And at the higher level, we created a debt action plan that allows the president of the African Development Bank and all others to engage in high-level dialogues with the G7, with the G20, with the IMF, with the World Bank, on several other ways of helping to mobilize external capital resources to help Africa to grow better, like the SDRs, the special drawing rights of the IMF that was done, and the DSSI, the debt suspension and debt service suspension initiative that was done. All these helped Africa to ease the fiscal space, but that is not enough, because the continent needs to do a lot of structural reforms, country by country, depending on how the structure of the economy is and what the sources of revenue could be for those countries, and also manage external flows so that we'll be able to keep the resources generated on the continent for productive investments on the continent.
Okay, okay, Prof. Let's take a look at the different regions. Africa has 5 regions, and I want you to just dimension them in 3 minutes because we've got to go. I see from the report that East Africa is showing significant light than other regions, that East Africa is expected to grow, I think, about 5% this year and 5.4% in 2024. Central Africa is doing better, or will do better than East Africa, then followed by, I think, North Africa, West Africa, then what else? Okay, Southern Africa. Southern Africa, there it's really it's the region in Africa that will be doing quite poorly than other regions from the numbers which you've given to me. So please just dimension these regions in just about 2.5 minutes.
Okay, thank you very much. You know, the reasons, it also draws from what I've said already. The reasons why we see these regional differences drive a lot from the structure of the economies that make up these regions. We find that commodity-dependent economies always face more volatility in their growth trends, depending on what happens in the global market. Reason is because even though Africa has dominance in the world with regard to this natural capital, we don't control the prices in the market. So because of that, countries that rely a lot on export commodities and exporting commodities always face a lot of significant volatilities. So that is why you find that countries in the Central Africa region did quite a lot better than the rest of the regions this year, primarily because of favorable prices in the global commodity markets. And also some prudential policies that have been implemented in some of those countries. So we project that Central Africa would have grown by 4.7% in 2022, and that is up from 3.6% growth rate in 2021. Southern Africa, as you mentioned, has suffered a lot more from COVID-19. A lot of the economies are more integrated to the global markets as well. And because of that, the higher price and inflation rates that we've seen, and also weak demand in the global export markets, and other factors, but also structural challenges that we saw in South Africa because of power outages, dragged down the GDP growth to 2.5% in 2022, and that is down from 4.3% in 2023. West Africa, the region you are speaking from, also saw a slowdown from 4.4% in 2021 to 3.6% in 2022. But this was primarily due to slower growth in Nigeria and the larger regions of economies in the region, and also Cote d'Ivoire. Now, North Africa was a little bit more stable. It had 4.3%, still down from 5.4% in 2021. But this is because of a significant contraction we saw in Libya because, again, of the oil price fluctuations and also the risks of conflicts that happened there, and climate change impacts on Morocco. And these are two large economies in that area. So Morocco had significant droughts, and that affected agricultural productivity. And in East Africa, we had 4.2% in 2022 of growth rate, GDP growth rate, compared to 5.1% in 2021. But again, this is also because these countries were a lot more exposed to the global financial market, and there were also climate shocks and risks of insecurity in the Horn of Africa. So, but on the whole, when you look at the whole continent, all the regions of the continent maintained a positive growth with a stable outlook in 2023 and 2024. And that is why we maintain some cautious optimism on the continent, bearing in mind that several risks still remain. Like I've mentioned, we have the global recession and softer demand. We expect that to continue in most of our export markets, and that will affect Africa. Higher interest rates and cost of debt service may continue to increase debt service and the risk of debt default in some African countries. You've mentioned some of them. But again, the heightening of the physical risks of climate change and global high climate events like risks of flooding, droughts, cyclones, and so on will continue to decimate economies on this continent. And that is why climate smart development becomes the way forward. But we also have this general challenge that Africa has continued to have, which is commodity dependence. The longer we continue to depend on selling commodities and not rising to producing manufactured products, that is how we are going to continue to depend on the fluctuations and volatilities in the global financial markets. And if you trace the whole history, the global financial market is always marked with high levels of volatility. But the low risks we face, let me just mention three of them as we round off.
Prof,
we still have a low vaccination rate for COVID at 26%. Is a far cry from what is required for herd immunity. So we have still risk of other health pandemics or new variants of COVID on the continent. But regional conflicts, localized conflicts that we see on the continent is a big worry in several countries, and many large economies of the continent are facing political changes of the helm of affairs through elections. So how these elections happen will inform investor confidence around the region. Like we're expecting the elections in Nigeria in the coming months. The trend of that election, how peaceful it is, how transparent it is, will have a significant impact
Okay, okay, Prof. I want to say thank you very much for joining us, for your deep insight. I wish we could not close this show, but perhaps you will promise me you will come back again when next I invite you, because we have so much to talk about Africa, especially coming from this report. So I would organize another time with you so that we can have another interview. Thank you very much, Prof, for joining me today from Abidjan, Cote d'Ivoire. Thank you.
Thank you very much, Nancy.
Thank
Always
you.
great to be with you. Thank you.
Thank you very much. I've been speaking. Thank you, Prof. Thank you very much, Prof. I've been speaking with Professor Kevin Urama, who is the African Development Bank's acting chief economist and the vice president for economic governance and knowledge management. Like I said earlier, the AfDB has brought out its report, the macroeconomic performance and outlook report, and that's what we've been dissecting in the last few minutes. Thank you all for being a part of the show. Be the best you can be and be the change that you want to see. I am Nancy Naji. I'll see you all again next time. Bye.